Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I will be your host for about the next 20 minutes or so. Uh, well, this Wednesday, we did not have an Options Guide TV. We actually, Tradier had a big overall webinar with that was also sponsored by the CBOE Global Markets. So we decided to actually just move on with all that content and not talk about what we did in Home Depot on Monday, which overall turned out to probably be a good thing. So we've had quite a few solid trades, speculative trades over this quarter's earnings. As a matter of fact, I think almost every one of our paper trades that we did on a short-term basis actually paid out until Monday's trade on Home Depot. And the one thing that has proven to be, I guess, the MVP, if you were to assign an MVP to the economy, is the consumer. And on Home Depot, we just kind of decided, well, maybe we'll get a little bit of pullback on Home Depot, but the market's actually just too strong. One of the biggest things that has happened recently, in my mind, is we got rid of a big uncertainty about the government not being able to come up with a budget. And once again, the government and the House was able to kick the can down the road. Now we're going out until mid January. I think it was the 19th, where we're going to have this talk again. But the marketplace was very excited about that. As a matter of fact, we didn't even go down to the deadline this time. The government was able to come up with a bill and get it passed, and that taken away. And not a lot of people were talking about that, but in my mind, that was a big driver of the bull run that we've had. I still think we're going to have to do this dance again. But when you saw the yields come down in the 10-year, market's feeling pretty confident about the Fed. Well, first of all, there's no probability in the next Fed meeting that, according to the CME Market Watch, that the Fed is going to increase rates. But if I look at the Fed Watch tool, which I'm not going to pull it up, but I have it over here. But if we go out to the March meeting, which it looks like that's on the 20th in 2024 of March, we're now seeing about a 30% chance that they might actually cut interest rates. That leaves about a 70% chance that they leave the market right where it's at. So that's totally flipped the script. So we've gone from a probability, and not that long ago in March, we actually had both sides of the coin. There was a probability that they might raise interest rates and a probability that they might cut interest rates. So right now, zero probability, according to the CME Fed Watch, based off of the futures prices, that they are going to raise interest rates in March. Now, obviously, this is much more important closer to the date. It's a little bit more accurate as we get closer to the date. But it's just interesting that the marketplace does think in early 2024 now that the Fed may start cutting rates. And obviously, that's been a huge driver of the bullish market. You remove the uncertainty of the budget talks, which we're going to come back and have to deal with that again. But you take that out of the picture, and just the fact that they were able to do it not going all the way up to the deadline. I think that also helped things out quite a bit too. So with all that said, market hit 4,500 for the first time. I should say the S&P 500 index hit 4,500 for the first time in quite some time. So very happy to see that level. We're struggling to try to break through it. And I kind of think that that's going to be the case throughout the day. We need to establish, where are the parameters as we hit this new high. I was trying to look for my SPX 4,500 hat from way back in the day, because it is kind of an exciting event. We've just been hanging around 4,300 in the SPY and 4,400, but 4,300 was really just an area of support and resistance, and we just seem to be bouncing off that number quite a bit. So if we go and our the most recent high is about, let's see right here, about 45.66, and that was in July. That's where we were at, 45.66. So obviously in the near term, looking at a 1-year chart, that would be an area that we'd be interested in. We'd like to know, are we going to break through that more recent high, or are we going to bounce off of it and come back down? So in general, I think the marketplace is bullish. The news that we got from Target, that we got from Home Depot, showing that we still have that strong consumer. We still have slow growth in unemployment. A lot of the strikes are getting figured out, and all the labor concerns with the actors, with the writers, with the auto companies. So things are starting to look a little rosy, and it's always weird to me when September and October start to hit. I still that seasonality, and why doesn't this news ever come out at the end of September? It always seems that we have to get into November to start getting solid news or better news in the marketplace. It seems very odd that always happens. But I'm happy that it has happened. I'm happy that we've started to get bullish. And with that said, today we're going to have kind of a short show. We'll look at what happened in Home Depot, and we'll start thinking about adding a retailer to our portfolio. Probably going to let this week play out, and we'll go look at our paper trading portfolio. And I'll talk a little bit about what my thoughts are on this portfolio that we're putting together. The TradeHawk software has an excellent tool, a paper trading app, to be able to get used to the portfolio. All the tools are inside it that you get into normal trading, but you can obviously place trades that don't get executed. We have a $200,000 portfolio. We're going to buy some deep in the money option contracts, and we've already started that. So at this point, let's run over to our portfolio and let's talk a little bit about what we're going to have to do next week inside our paper trading portfolio of deep in the money option contracts. All right, so there we go. If we look at this portfolio right now, let's just review where we're at. We bought Caterpillar, strong industrial. We bought Google. So we have one of the Magnificent Sevens advertising. Google has actually gotten beat up. They actually had the worst earnings report this year out of all the Magnificent Sevens. They were beat up. The market has came back, but on this position, we are down the most. Right now, it's down about $600. On the Caterpillar position, we're up about $1,000. Now, note that we've sold call. I should have probably started by saying, let me explain what we're looking at inside the portfolio. This is the deep in the money call option. So for the first time, mainly because I am now independent and I can kind of talk a little bit more candidly about a position without getting scolded for it. I decided, using this great app, that I'm going into November and December, and we've talked about this on a lot of the Option Guy shows, I'm going to put a portfolio of deep in the money options together. And I've decided if it's going to be 5, 6, or 7, it's going to be a manageable number, a number that I would have inside my own portfolio of stocks. I don't really believe that you should ever have 15 or 20 different stocks inside one portfolio. I think that's too much to manage, especially if you're going to do it trading options, because with the options contracts, you do need to manage them. It's that simple. So it's going to be a portfolio of fig leaves, and not a lot of. I think the bulk of the option trading community has came to embrace the term fig leaf, which is inside the Options Playbook. It's a strategy that was always one of the more popular strategies that never had an official name, like Iron Condor, Butterfly. So I gave it one. And here's the concept of the fig leaf. If you go to Options Playbook right now, or you just Google fig leaf option trade, it'll come up. The concept is that you're kind of covered. If you buy a deep in the money call option as a surrogate for the stock, if you do that trade, you are covered, but you don't own the stock, and you're selling shorter term options against it. So you really don't want to be assigned. If you're doing it, there's a lot of covered call traders that will sell a call, and if it gets taken away, no problem. You can sleep right through it, right? All that happens is you sold your stock at a higher price than where it was trading. That's what a covered call is, and that's the whole process of it. But if you have a deep in the money option contract, as opposed to owning the stock, and it gets assigned, now you don't own the stock. You own this long dated option that's got a whole boatload of time premium in it. And you got to figure out what you're going to do with that position. And more than likely, you're going to want to sell the long-term option contract and then go out and buy the stock for the assignment on that call option. We'd really just not like to get into that position. So if the stock ever hits the strike, we're going to look to roll or close the entire position. And so far, none of our positions have gotten there. So on Caterpillar, here's our deep in the money option contract. And let me see if I can toss Cat over here so we can get a good quote on it. So Caterpillar's at 253.51. We bought the 210 strike. So we're about 43 points in the money. That position, since we put that on, is up about over $1,000. And then we've sold a call against it, but then we went out and sold a second call against it. So this is our second call. Right now we have 7 days to expiration, and it's the 250 call. So on this position, we need to do something. As a matter of fact, we should have done something when it hit that 250 strike, which we might have done on Wednesday. But so we're going to take this position right now, and we're going to roll that trade because we're in the money. And you'll notice that nothing else has the in the money situation. Well, let me highlight this. So this is in the money and it's red. This is in the money and it's green. This means you have a lot of time value. This means you don't have a lot of time value. Right now is the 17th. So next Friday, we're going to have a scenario here if we don't do something about this call option. So here's what we would do. We're going to hit roll. And then we're going to go out. So right now, when we hit roll, it defaults that we're going to buy to close this option contract, which is the 250 strike with the 11/24 expiration. And if we move this and we stay at that same strike, it's saying that we can get it done going out, I guess, what is that? One more week to 12/1 and get it done for a credit of $1.30. Now, if you're rolling it, that's okay. If you truly think that the stock may come back down below the 250, then you can roll it, bring in a decent credit, and just give more time for that scenario to play out. But if not, we want to roll up and strike, and that would be our ideal situation. So we'd go to the 255 strike and sell that to open, but now that's done for a net debit to the account. So we're going to have to go out further in time. So if we go all the way out to the end of December, which would be 12/29, and we don't even need to go that far. Let's go less. Let's go 12/22. Okay. So now if we do this and we got the 250 strike call, we can get that done for a net credit to the account of $1.55 on the midpoint. I'm okay with that. So what's the moral to the story here? We kind of fell asleep. Usually you want to roll when it hits that 250 strike. And there's going to be a little bit of that because we're going to try to manage this portfolio mainly on the show. When it hits that 250 strike, you have a limited time. If the stock gets deeper and deeper in the money, it gets harder and harder to roll. It's kind of like if you drive your car and you have a little fender bender, right? You'd kind of bump into somebody else's car. Well, at that point in time, it's fairly easy to fix that car. But if you bump into somebody's car and that kind of pushes you off the cliff a little bit because you waited too long, and all of a sudden, boom, you're in the bottom of the cliff, there's no repairing it. So you need to get it done as soon as the accident happens. I don't know if that was a decent scenario, but you can laugh at me if you want. But bottom line is, when it gets to 250, we got to do something because we have a fig leaf and we're kind of covered. That simple, that straightforward. All right, so we've salvaged this one. We can do the 250, and I'm just going to take a second. Now, the sad thing about this, and I did already kind of look at this, is we only have 5-point strikes. So if I go to the 260, which I would prefer to do if I could, but I don't think we can get that. Yeah, that's a debit to the account, and we're covered call sellers, not covered call buyers, right? Where we're paying a debit. So ideally, we don't want to do that. If there was a 257.50, a 2.5-point strike here, we could probably get it done, and it would be a little bit less of a credit to the account. So I'd feel a little bit better with that. But let's kick the can down the road, just like our government likes to do. And let's click on the 255. We got a 155 credit. We got a pretty wide market, 180 by 130. It isn't a paper trading portfolio, so it's a lot harder to fill at that midpoint. So let's put it in at a net credit of 135. Let's click on that. 135. There we go. And we're going to send that to the floor. And send your order for a short diagonal spread with calls. It's a diagonal because you're buying to close the 11/24 expiration and you're selling to open the 12/22 expiration. So the diagonal term comes from being down on the trading floor, and you would look diagonally on the quote boards, or diagonally this way on the quote boards. And that's where the term diagonal is. That simple. It's just the way the quote boards were laid out down on the Chicago Board Option Exchange when they first started trading options. Boom, set. All right. It's not filled. I'll make sure that it fills today. I'm going to leave it in there at 135 net credit to the, there we go. Nice. Yep, we're filled. Okay, so we're filled at that 135 net credit to the account. And it looks like that actually moved on us. So that was a good thing. All right. So now no more concerns. We got that position on. We rolled that out. The NVIDIA call is going to expire today. I guess I could roll that. I mean, I would look at it. I would normally just let it happen. If I looked at NVIDIA this morning, it's not even close to that price. So let's go back and look at this position. I can't get that quote to come up. Oh, that's interesting. Okay, NVDA, that's actually the option that popped up in there. All right. That's why that's in there. I remember I clicked on that. 1 second. NVDA. Add. There it is. 149. Okay, well, 491, and we're in the 505, and this expires today. So how much time we got? Yeah, I suppose. Let me say this. First of all, I think we'll roll this. And then we'll call it a day for Options Guy TV. We're going to buy back. We're going to have to probably pay a nickel to buy this back. And if you have any questions about our paper trading portfolio or the Home Depot trade that we did on Monday, and I should just point out that Home Depot gapped up, so there really wasn't much you could do. We were long a put spread. It just would have went out worthless. You might have been able to, if you were quick, maybe you salvaged 15 cents or so and you closed it out on the open. But besides that wasn't really worth noting. We managed our risk. We were out of the money. We didn't have a lot of risk on the trade. We were speculating on it. And so if you have any questions about that, I'm happy to answer them. Just put them in the chat box and we'll try to address them. If not, let's roll this NVIDIA. so that we don't have to do this maintenance on Monday. We're going to have the Charles Schwab position. That's up. That was a most recent one we put on. That one's going to be expiring in 7 days from now. And then also we're going to have the Google position that's going to be expiring 7 days from now. So we have all these positions that we're going to have to manage. I'm just going to close this NVIDIA one out, and we will roll. Maybe NVIDIA's got enough premium in it that we might even be able to just go out 7 days so that we can do this together. So let's go look at that. 7 days away would be the November 24th expiration. November 24th, stocks at 490.50. I feel like that's kind of waiting for it to update. I apologize. Let's clear this out. Bid and ask 2 by 2. Yeah, that is. Oh, we have earnings. But man, is that a real quote? So we got a $2 option contract, and then we got a $20. We got earnings. That's why we did it one week earlier. That's right. So we're gonna ride earnings on the video. I totally know what's going on. Okay, so there was a lot that just happened in my head there. I wasn't planning on talking about NVIDIA today, but it was expiring, so I thought we had some time that maybe we would roll that. But NVIDIA is the last of the Magnificent Seven to announce earnings. So when I went to the options grid and I had this option contract, which is expiring today, trading for $2, and then I went out 7 days and the at the money option contract was trading for $20, I thought it was updating. I'm like, well, those quotes aren't right. That can't have that much premium in it. But yes, it can. Why? Look at the implied volatilities. That's how I noticed that, oh, by the way, there's something going on. So I knew in the doldrums of my mind that NVIDIA was going to be announcing next week. But I'd forgotten that. So when I was thinking about rolling this, and that's 100% why we didn't do the same expiration as the Schwab or as the Google. We wanted this option contract to expire before we went into earnings. And I completely remember that conversation that we had on Options Guide TV. So this is just a great example of being aware. Like, look at the implied volatility. That was the biggest hit. The IV here is around 46. It doesn't have much life. It's got today before it expires. But then we go 40, 72, 58, 53, 50. That means there's something that's going to happen in this expiration week. And that is exactly what the marketplace is telling me. This premium was too good to be true. So I paused. I thought that maybe because we're in the paper trading app, it was taking a while to update, but I was incorrect. That is what that is, 490. So that was a $20 option contract going into earnings on a $491 stock. So do not want one of the golden rules on a fig leaf, even though we're going to sell it, we're going to continue to sell premium. We're going to sell premium all the way until we feel fairly bullish in the marketplace. Right now, the biggest sign of bullishness might be that March probability that the Fed might cut interest rates. That's probably the most bullish thing that I can see in our future. We're going to have to get through another debate about the budget for the government. So that is the most bearish thing, besides obviously all the geopolitical concerns. That there's a lot of, for lack of a better term, landmines with everything that's going on with all the conflicts that we have across the globe. So with that said, we're not going to do anything on the NVIDIA trade. And I'm actually kind of glad that happened, because I was very befuddled by the fact that this was trading for $20, this 490 option contract. And we figured out the reason. They're going to be announcing earnings next week. So we'll look at NVIDIA, and we'll probably do a speculative trade on NVIDIA. It's one of the I think it is the last of the Magnificent Sevens stocks to actually announce earnings. So we'll look at a speculative trade, probably some type of butterfly on NVIDIA. And once we get done with the earnings announcement, we'll go out and we'll sell another call against that NVIDIA position. All right. Well, that was fun. It's time. That's it for this edition of Options Guide TV. If you could please click subscribe, ring that bell, you'll get all the updates for the next Options Guide TV show. Please pound that thumbs up. It helps us out a lot. And we'll see you this Monday for the next edition of Options Guide TV. Thanks for coming, everyone.